Well, thanks for joining us, everybody. We'll go ahead and get started here. As we saw last week, rates ultimately held steady from Monday through Friday with a little blip there. But after the FOMC statement, we had some buying on Friday and had rates eventually moderate for the week. But today was completely different, and we saw Treasuries jump to the next near-term resistance, which should be 370. And mortgage backs sell off well under 101 on the 4.5 coupon. And so we'll have to see if these levels hold. Technicals suggest they would, but we have a lot of data this week. We have a thin volume in both the stock and bond markets, and all sorts of dynamics that could set up for some exaggerated moves here. And so let's take a look at what we have for the week in the calendar. We have tomorrow at pre-market at 8:30 Eastern. We'll get the final revision of the Q3 GDP. It's rated high because that's a very highly watched economic number. However, it's been revised. This will be the third and final revision, so it really shouldn't come in much different than what we've seen already. However, if it does, that could certainly move the markets. And then at 10 o'clock, we'll have existing home sales, moderately important. The markets will be watching it for signs, certainly, of continued health in the housing market. Then we move on to Wednesday. As we always get at 7 a.m., we'll get the MBA applications low, but markets do watch for activity in the mortgage markets. Then at 8:30 pre-market, we'll get both personal income and personal spending, and both of those will be highly watched in terms of consumers are out there increasing their incomes and spending as they contribute 2/3 to GDP. And at 9:55, we'll get the University of Michigan Consumer Sentiment Report. Of course, that will be high as everybody will be looking for consumer sentiment going into next year. And then we'll have new home sales to follow, and that's at 10 o'clock Eastern. And again, moderately important. But again, markets are watching housing, which appeared to lead us into this recession for signs that it will lead us out. And then Thursday, Christmas Eve day, a few data points. We'll get durable goods report, and can be high impact, but relatively moderate, we would expect. And then, of course, every week we get the weekly jobless claims, and that can definitely be a market mover. The bond markets will close early on Thursday for Christmas Eve at 2 o'clock Eastern, and then they're closed for Friday as well. And so that's the week, and it's really packed in with a lot of data. And as we said, as we saw today, in fact, what thin and light volume, trading volume can do. We saw big moves in bonds and mortgage backs, and really that was on the back of some comments again, reiterated from Thursday, as we said, China reiterating their position that they're not real happy with the yields they're getting on bonds, and the Fed continues to keep rates low, that they may not participate as heavily in bond purchases as they have, and that certainly caught the attention of bond traders, as you saw today. And we had Morgan Stanley calling for a 10-year of 550 this time next year. It's up 200 basis points, which is way out of most expectations. We saw some roundtable from the bond experts data this weekend that would suggest certainly somewhere between 4 to 4.5 by this time next year, but nobody's expecting anything around 5.5. Certainly an outlier. And then you have outliers the other way that are expecting maybe 3, 3.25, or maybe where we're at today, maybe 3.5 range on the 10-year by this time next year. So, but something in the 4 to 4.5 range certainly seems to be consensus. So it does appear the economy gains traction, that bonds will lose their luster here, and that yields could be jumping up a little bit. But we do expect, for now anyway, 350 to 370 to hold. We'll be watching that tomorrow. It's tough to call ranges right now when you have thin volume because you can move real rapidly, way outside ranges, and that may have been what we saw today, but it remains to be seen. So you have to remain defensive. We were floating over the weekend, but locked pre-market, as you saw our alert, and we'll be floating into tomorrow morning pre-market to see if GDP has any impact, if bonds or the sell-off is continuing. So stay tuned. Again, a tight week ahead of us here with data in terms of number of days to digest, and we will keep you posted. And for those of you that are not part of the mortgage advisory alert service, you're likely getting mortgage advisory from us in some fashion. Josh just put this up on the screen here. You may want to participate in the actual alert service. For those of you on that today, I got 4 or 5 emails keeping you posted on how prices were moving throughout the day. That's part of, by the way, an accreditation service. If you're not already an accredited lender with us and you're not already a mortgage advocate, certainly take a look at the link on Josh's page here. And you can also access it by, I think the link is I'm a Lender on our website. And take a look at the benefits there, certainly gaining traction with many loan officers around the country and becoming more highly recognized as a designation of a distinguished designation by consumers as well. And so there's the week. Look forward to the rest of the week, and happy holidays if we don't talk to you before Thursday and Friday. Have a great week.